All right. Good morning, everyone. Let's get started, shall we? Hope the sound and technology are working well for everyone. And thanks for joining us today. Happy Friday. And for those of you here in the United States, happy Juneteenth, which is not, by the way, a new holiday for my colleagues in Texas. I'm Mark Finley. I'm the fellow in Energy and Global Oil with the Baker Institute's Center for Energy Studies. In recent years, we've seen an absolute stampede of analysts calling for global oil demand to fall. This has been largely driven by the expectation of a major acceleration in climate policy and technology innovation, especially anticipation of rapid growth of electric vehicles. At first, it was trendy for analysts to compete over who would forecast the earliest peak in global oil demand. Would it happen in 2040? How about 2035? Do I hear 2030? Then the tragedy of the COVID pandemic struck. And last year, we saw the largest ever annual decline in global oil demand, which the International Energy Agency in Paris says fell by 9 million barrels per day from its pre-pandemic level of about 100 million barrels per day. Now, the buzz among the demand bears is that global oil demand has already peaked and will never get back to pre-pandemic levels. So now the new race is to see who can have the biggest and fastest projected decline in world oil demand. In its new net zero scenario, the IEA, which assumes much more aggressive climate policies, imagines a world in which oil demand could fall to as low as 25 million barrels per day by 2050. But as the great American philosopher and baseball player Yogi Berra was reported to have said, it's tough to make predictions, especially about the future. This year, we're likely to see the biggest ever increase in global oil demand, with the IEA now projecting growth of over 5 million barrels per day. Indeed, in its latest 5-year outlook, which we discussed here in a webinar in March, the IEA has global oil demand reaching new highs over the next couple of years, in large part because climate policies in place today are not aggressive enough to force the change envisioned in their net zero scenario. Something, by the way, which the IEA itself is saying. And of course, it wouldn't be the oil market if there wasn't debate. Other analysts, of course, have forecasts for continued growth in oil demand. OPEC, for example, has a long-term outlook that shows global oil demand rising to 109 million barrels a day by 2040. So what will it be? Up or down? For oil demand, a lot depends on that. Will OPEC need to keep raising production? Will US companies need to keep investing in new production? Will we successfully grapple with the challenge of climate? But what if we're asking the wrong question? What if separate structural forces already at work are impacting the oil demand outlook? My former BP colleagues, Christoph Rühl and Tiet Erker, have published an interesting paper arguing just that. I won't steal their thunder. We're fortunate to have Christoph with us today from Germany to discuss. And I invite you all to read the paper for yourselves. A link is on the website. Christoph Rühl is a senior fellow at the Harvard Kennedy School, as well as a senior research scholar at Columbia University's Center on Global Energy Policy. Following Christoph's brief presentation, we'll have a discussion of the drivers of oil demand, pun intended, by the way, with two industry thought leaders. Sarah Emerson is president of ESAI Energy, a leading consultancy and authority on oil demand and refining. Dean Foreman is chief economist at the American Petroleum Institute, with long experience as an oil and gas company economist. All of the speakers' bios are available on the website. So the plan today is for Christoph to speak for about 15 minutes. I'll then invite Sarah and Dean to comment on the paper, but also to add their own perspectives on future oil demand prospects and key issues to watch. After a brief moderated discussion, we will take your questions, which you can submit using the Q&A button at the bottom of your screen. With that, Christoph, thank you for joining us. And again, over to you.
Thank you, Mark. That must have been, I was trying to calculate since when we have been in one room doing something like this. It's a long time ago and it's a virtual room. But anyway, good morning, everybody. Good evening, good afternoon, whatever the case may be. The story which I'm going to tell you, and I try to be really very brief in these 15 minutes, is actually two stories. One is what Mark has already touched upon and has outlined the broad lines of discussion, the question of peak oil demand. Will we see it? When will we see it? What's going to be the key driver? The other is the observation of an amazing regularity, which has been with us for 3.5 decades, which crept up in the sort of day-to-day work, which I was doing when I was thinking about oil demand and doing presentations about the possibility of peak oil demand, and discovered that regularity. And then at some point, somebody put my nose on it and said, you have to put these two things together. You cannot just say there is a regularity and then jump on and talk about demand. You have to explain that regularity. And let me just start by doing something very simple, just to show you how my nose how I sort of came up with that. When you think about oil demand, then it's natural to think about oil intensity, which, as we all know, is the ratio between GDP and how much oil you need sort of per unit of GDP. And when you do that, you discover that we have, unsurprising, a history of improvements for a long time now. There's different ways in which you can look at oil intensity, but one of them certainly is that you can look at it as an efficiency measure, or as a measure of how important oil is for an economy. And when you do that, then you would expect over time the amount of oil which you need to produce 1 unit of global GDP or $1 of global GDP to come down. Here on the left-hand side, we have sort of the starting graph of this observation. Global oil intensity is falling. It hasn't been falling all the time. It is falling since 1984, to be precise, in a regular fashion. It is falling since the late 1970s. That is because we had periods, especially in the run-up when oil was sort of broadening and becoming the biggest fuel, where oil demand grew faster than GDP. And that shows up, of course, as an increase in oil intensity. That was the case when oil sort of really went into the nooks and crannies of the global economy, and when the transport system was rolled out. It lasted until the 1970s, the volatility of the two oil price shocks. Then it fell very steeply for a while. And since 1984, there's a very regular trend in the way in which oil intensity declines, in the amount of oil we need to produce, say, $1,000 of GDP, going down more and more. Give you some numbers of that, which are sort of interesting in their own right. In 1973, when that relationship, oil intensity, peaked, you would have needed more than 1 barrel of oil to produce $1,000 worth of GDP. So 1 barrel of oil, I know, is 59 liters, and I wrote down somewhere it's 42 gallons for $1,000 of global GDP. Just pause there for a moment. It's an incredible figure. Makes it clear why oil was so important. And then it continued to decline. And if you would have asked the same question in 2019, last year with data before COVID, before the pandemic, we would have gone down to fallen by more than half, about 60% to 0.4 gallons. Still a large amount, but much lower amount. Now, what I used to do when I looked at this and I found out that this is actually an extremely regular relationship. And we, without thinking, started talking about it as a linear relationship, not an exponential trend. A linear relationship, meaning that it looked to us as if the amount of decline, the volumetric decline, was the same year after year after year. Next slide, please. And this is, Mark, can you move forward one slide? Yeah. Here's what we then get. This is the linear trend of oil intensity over time since 1984. Look at the R square for those of you who are more on the technical side. For those of you who are not, let me just tell you, it didn't only look like a linear trend. It is, or it has been, at least until this point in time, a linear trend with an enormous statistical significance. And so I would then go around and tell people, okay, here's this funny relationship between oil and GDP, which is obviously a very key relationship. You know, oil consumption, very important, GDP, very important, put them two together, hyper important. And there's this regularity, and it has been with us for 3.5 decades. And 3.5 decades is a very long time with the rise of China, the collapse of the Soviet Union, all sorts of oil cycles and so on. And why don't we do the following as a thought experiment? I would tell my audience, why don't we assume, just for the sake of argument, that this kind of very stable trend apparently continues another 10 or 20 years and see what happens and try to use it to make predictions on oil demand, and in particular on the first part of what Mark raised on peak oil demand. And if you do that, Mark, can you go one further? If you do that, then of course you take this trend of oil intensity, you assume that it continues in this linear fashion. You know, this goes, I think it's 1.4 liter per $1,000 less every single year. And you add some run-of-the-mill economic growth forecast. Usually, you know, stayed with IMF run-of-the-mill economic growth forecasts. And that will tell you when, just arithmetically, the system will create peak oil demand. And here, the peak oil demand, and these are the latest numbers, they change with GDP revisions at some point, was in 2026. And that seemed to be a very coherent story. Until, that is, somebody came along, another fellow energy economist, and said, hold it. I think he just didn't believe in the existence of this trend in the first place. He said, hold it. You know, you can't just say there is this linear trend, because we all know, of course, linear trends for economists are a problem because they can't continue forever. So something must be wrong here. And at a minimum, you have to have a good story why you would take this trend and assume it's more than an accident and base forecasts on it, even if it's just as a, he clearly didn't believe in sort of the magic of linear trends as deductive devices. And so that's when we started to try to figure out what was actually going on. But one thing I want to take out of the discussion right away, we went through the exercise with different data sources for oil consumption, BP, IEA, EIA, for GDP growth, World Bank, Oxford Economics, you name it. This thing which looks like, and which so far is a linear trend, is there and hasn't been gone away and has been with us for 35 years without, funnily enough, anybody noticing. Now, let me show you one more example. Can you go to the next slide, please? No, one further. Yeah, so this is the same exercise, but now I put in as an example for you the pandemic. So this is the very latest data. We have 2020, this enormous decline in oil intensity. Why is there this decline? Because, of course, during the lockdowns, oil consumption, as you all know, was much more affected by the lockdown and by the declines than GDP, and so it declines stronger, so the oil intensity goes down. And then if the trend would reassert itself, then we would have now a shift to peak oil demand by a few years. I think it would go to 2020, well, still 2026 at that point. And so you can experiment, you can plug in different things. I show you one more. I should address one more issue before we go broader again, which is over all this time, there have been, of course, deviations. There have been periods in the 1980s when oil demand growth, when oil prices were very low, and when you saw oil demand growth strengthening a little bit. There have been periods like after 2000 when oil prices were very high, and you saw oil demand declining a little bit. And then recently, there's one period which looked to us like an outlier. So we were already prepared to say, okay, this trend was a nice thing while it lasted, but we missed it to write the paper because now it's gone. And Mark, can you go forward one more? And this is when you take the period here from 2009 to 2019. And that is a flattening of the trend. So the oil intensity didn't come down as much anymore, meaning that just as an effect of low prices would have it, that consumption of oil sort of accelerated a little bit compared to history. And it is a trend exclusively driven by the US. And this, of course, what we think, what you see here is shale oil. Is not just the decline in prices, because the oil price is global and shale oil may have contributed to this, and there was a huge amount of variability, and we will talk about all of that. It's also something else, and we think it is the attitude of consumers in the sense that, at least in the US, they suddenly, this was a well-advertised case of resource abundance. They suddenly said, okay, let's go and let's buy this SUV now because we don't need Saudi oil anymore. We are safe, more or less. And you see that actually that uptick happened in the US and it happened in transport demand. And in the back of that is this huge escalation in the purchase of SUVs, which we can discuss. Then, just as we were prepared to give up, COVID comes along, right? So that's where it gets funny, because COVID, of course, has the opposite effect, is likely to bring that trend back to its own right. Now, I want to make a distinction before finishing. There is this question, why should there be a linear trend? And there is probably no good reason why there should be a linear trend and not an exponential trend. And it probably was an accident. And guess what? In the end, it doesn't matter. The other one is the question, why is there this enormous amount of regularity to the point where it sort of completely seems to dominate price effects over the long term? And that's the part which should really be irking to economists. How can this, something that more important than price effects? The explanation we came up with is a very simple one. It starts with oil demand in the end being derived demand. Nobody takes oil and consumes oil because he likes it. Nobody drinks it. Everybody consumes it to get some service out of it, like transport or heating. And for that, you need appliances. And what we do know is that over time, appliances have shifted more and more to final consumption. So the share of power generation has declined. The share of industrial use has declined. The share of transport, the share of home heating, so has not declined, has increased. Final consumption has increased. And when you look at the nature of appliances, then you will see that in that final consumption appliances, your car, your boiler at home, tend to be single fuel appliances. So there is no possibility of substituting in response to price changes. Whereas the appliances which are used to generate power, either because they're systems with redundancy or because they are just switchable, and the appliances which are used in industry have a higher degree of substitutability. That's one side of it. So substitution is bigger in oil elasticity to prices, therefore probably bigger in the industrial use. The other is that during the age of globalization, which covers roughly that period, it is of course mostly final use appliances which spread like wildfire across borders. And these days, if somebody in India invents a car engine which is a little bit more efficient than somewhere else, then the next day it shows up in Japan or in Germany and people want to have it. Whereas the use of, for industrial intermediate uses of oil is still more lumpy. It's still often into strategic industries, which are not allowed to spread like that quickly. And it's still more often than not owned and controlled by governments. And so that makes for a slower diffusion. And the bottom line is for us, it is the combination of having less substitutability together with the switch to final consumption in the appliances which dominate final consumption, with globalization, with the rapid spread of efficiency improvements, which then translate all of this in the product cycle. Car fleet turns over in 10 years, and you see for that reason a very steady movement of oil intensities. And what I would continue to argue is that under these conditions, it is legitimate to use that concept as a forecasting tool. It tells us that we should be prepared to see peak oil demand somewhere at the end of this decade. And it seems to me, of course, that will not be right. There will always be something in between. But it seems to me almost a more legitimate way of looking at the limits of oil consumption and of the eventual peak in demand, which will become, than other proposed things. And the reason for that confidence touches on something which I again leave for the discussion. We have, of course, areas in the world where oil demand has peaked for a long time ago. The European Union has never again used as much oil, consumed as much oil as it did in 1979, even though the economy has more than doubled. OECD 2005, Japan 96, US, if it stays that way, 2005. In those areas, you could have become very rich if you would have based your predictions on oil intensity. Let me just, to conclude, show you a few slides, which is not evidence of anything, but it underlines, not yet, can you go further, one more. These are, if I see this here, the sector slides, it sort of underlines what I just said. The trend is much stronger and much more visible in transport demand, for example, than in industrial use. And if you go one more, so in other words, it's more evident in final consumption use rather than intermediate uses of oil. And here regional also you see that this is not a chimera, so it holds across all the regions. But those which have already peaked sort of have the strongest relationship. And in the non-OECD, with the bouts of globalization and industrialization about us, it's a bit more tricky. So that's the basic hypothesis. It comes from globalization, this rapid spread and the equal spread of efficiency improvements around the world, plus the shift to final appliances, where this is embodied in the appliances and where you have very little effect for substitution. That makes it to a large degree price independent. And when you actually apply it to the nitty-gritty, you can see that it seems to be I don't want to say it, it's more interestingly, one of the few, very, very few treatments of this, not trying to explain it, but using it, was an IMF publication, which I saw. And they jumped as far ahead as to say, okay, we are using this now. We don't need prices anymore to make an oil consumption forecast. So I wouldn't go that far. But it surely has shown, as this story of derived demand, and they fit together nicely, surely is a story where you need much larger price fluctuations now to generate volume variations than you used in the past because of the different way in which oil is consumed. To us, last point, back to the very, very big picture, this is sort of a gradual regime change in the oil markets in the making. We started out with a world where oil, that was an energy transition, just like coal replacing wood, driven by superior economics. It conquers the world. It's not only that there was a new transport sector with the internal combustion engine being rolled out. Oil was at the beginning cheaper, better energy quality, better density, used under the boiler, used everywhere. And as it exploded like that, it grew faster than GDP. Then you have this adjustment period in the 1970s, the rise of OPEC, the very high prices. You have oil consumption slowing down through the 80s and the 90s. And that sort of is to me a second period in oil markets which lasted until today, where you have oil demand increasing but slower than GDP. And that is what we were discussing, this period of sort of more or less regular improvements in energy and intensity. And if there is merit to the story, then sometime at the end of this decade or the beginning of next decade, sometimes around that, we will switch into a world in which oil intensity, in which oil demand will fall, because oil demand is now no longer capable of doing the same as GDP, which is growing. Mark, there was one more slide I wanted to show them at the end. Can you go back, or is it too late?
Nope. Hang on.
Time-wise, yeah, just about okay.
Yep, here it comes.
Okay, go backward. Backward. Yeah. What you see here is a wild card, because all through this talk, like a genuine energy guy, we talked about oil, one side of the equation, not about GDP. One of the things which are driving the worries about many economists, especially many economists around the Biden administration and in the more democratic camp, is that they look at what happened with the financial crisis 2008 and 2009, when obviously the economy sort of declined, and then obviously within 2 years so came back to the same level of GDP. But what you see here very clearly, trend growth has changed since the 2008-2009 crisis. This is now GDP trend growth, right? We have before that a trend since the 60s, actually even longer, very steady. And since the crisis, it has recovered, but has grown slower. And you see on the right hand, the pandemic here. Next slide, please, Mark. This is now really the final one. This is the fear of people that we would see something like that again, which drives to a large extent the support for this, money printing and for these very aggressive monetary and fiscal policies. Interestingly enough, the blue line here to the right, the trend line, which does recover, that, but not much more, that is the official forecast for the Biden administration with the Congressional Budget Office. So they don't believe in a return to high growth either, but they believe that when you spend all this massive amounts of money, that you return to the growth which we had before the pandemic. If that is halfway right, then of course there's now another big uncertainty to our oil demand and oil intensity story, and to our story of regime change in the oil markets, because it may be that we get hit from an unexpected corner, namely by secular stagnation being much more of a reality than many people realize, and trend growth in GDP slowing down, which would again change the picture and delay the peak a little bit. But that's just a concluding footnote. That's basically what I had to say. I know this is a lot of information to digest, but I trust we have time to discuss. Thank you very much.
I trust we have time to discuss it too, Christoph, in part because you were so disciplined with your presentation. Thank you for that. And we can't get remotely as deep as you do in the paper. So again, I'm happy and encourage people who are interested in digging deeper to read the paper that sits behind this that you and Teet have both written. Sarah, why don't I open the floor to you next for your commentary. And you're muted.
How's that? So thank you, Mark, for inviting me to comment on Christoph's paper. And thank you, Christoph, for writing this, because I think it is it's not just a sort of important paper, but it's a very entertaining paper, because you sort of point out, why haven't we talked about this before? Why haven't we had other economists sort of pointing this out? And so I found it very, very interesting. Really a great paper to add to the dialogue on oil intensity and oil demand generally. I just wanted to, I don't really have any, I don't want to sound like I'm not going to criticize or critique the paper in any way, because I quite like it. I would like to talk a little bit about how we got on this path of steadily falling oil intensity. And I want to talk a little bit, and you mentioned in the paper endogenous factors. And I think there are a couple really big endogenous factors, two in particular that I'd like to mention. Mark, I even have a slide I can show for one of them, if you like. Can I share?
We love slides.
Okay, we're sharing. Now I got to find it. Sorry, it was right here. It's this one really right here. So, so if you go back to Christoph's charts, and he's got some in the paper that are really great about power generation and this discussion of derived demand. And I just wanted to put out there the U.S. power generation by fuel.
Sorry, Sarah, we're looking at a Microsoft Teams invite on your screen.
Really? Wow. Okay. How do we get that to go away then? That's odd. It's not open. So you know what I'm going to do? I'm going to not share. Okay. And I'm just going to talk because it's easier. So if you look at, and Christoph has a good example of fuel use and power generation globally. And if you look at the United States, and specifically, and you look at the period after the oil shocks, we had actually a fairly aggressive change in public policy after the oil shocks with the, I think it was the Energy Policy and Conservation Act, which basically created the SPR, created the CAFE standards, and basically it encouraged the development of nuclear, and it encouraged the use of coal in power generation and the movement out of petroleum in power generation. And so to my mind, the reason you get to that change in the curve in his first chart is because you suddenly had governments sort of stepping in and saying, okay, we need to deal with energy policy because of these oil shocks. And it's not just the United States. Europe did some of the same things. Japan did some of the same things. We created the International Energy Agency so that we could do oil sharing. I mean, so the whole emergency response architecture was put in place. And so that got us sort of on this path of declining oil intensity that is described in great detail in the paper starting sort of in 1984. And the other thing that happened during that time frame that I think is really an important endogenous factor is we went from basically fixed pricing to market pricing. The emergence of spot, futures, and forward markets changed the way in which transactions were done in the oil sector. And in the process, encouraged efficiency. It encouraged conservation, encouraged better technologies. because basically the economic rent was squeezed pretty aggressively. And so in order to be profitable, you had to work in a market economy. And this all sort of tied together with the Washington Consensus and the reliance on markets and all of this. So to my mind, there were these two things that got us on this path that Christoph is talking about. And so when I think about forecasting with this tool, I find it very, very compelling. I really do. And I think, when we do the demand analysis, which I can talk about later, we come to a number sort of between 2027 and 2035, which is about where your two outcomes were in terms of peak demand. But I think the important thing here is it was, in my opinion, two big factors that put us on this path. And I'm not suggesting that pricing is going to change, but I could see a change in public policy that could be as big as what happened in the end of the 70s. And that would be a change in public policy that would be decarbonization oriented. So imagine a global carbon tax, or imagine the proliferation of border tax adjustments, or imagine a global form of LCFS, or if not global, at least in many of the consuming regions. I mean, so there's a lot of things that can still come down the pike that I think could create another kink in the line. And I'll stop there and let Dean carry on. Is that okay, Mark?
Of course, it's okay, Sarah. Thank you very much. And Dean, your turn. Dean, I think you're muted as well.
Apologies. Hopefully you're seeing a cover screen for presentation and sharing. Yes?
Yes, and hopefully This is not a straight linear relationship for all the speakers now.
Okay. So I like this paper a lot. I think it's an important area. It influences policy. It also influences how those in industry and agencies think about either forecasting or rules of thumb for bringing this forward. So there's some technicalities. I generally agree with the conclusions here. So the main observations and takeaways that oil intensities come down over time, not always smoothly, and that you've got regional convergence. Yeah, I think that's right. And we'll talk about some of the variances on that. The forecasting versus rule of thumb, how sound of a forecasting basis is this? Like Christoph mentioned, this is something that when I give presentations, I often use. And for my own short-term developments, it's certainly a way of projecting forward. And as an 80-20 rule, it basically gets you there. For longer term, I think there are different ways that we need to take this apart, and I'll delve into it a little bit. The other main observation and takeaway in the paper is that, for policy, that because of this consistency of this relationship, it makes it harder to decarbonize. And the authors make reference to needing a carbon price. I think that conclusion's right, but it's right for a number of reasons that are beyond just the linearity or the regional convergence here. So we'll go into it in a second, but linearity of this trend, regional convergence are both a function of time and the type of GDP that's assumed. A comparison between using adjustments for purchasing power parity, as you do here, as opposed to using actual or market exchange rates. And I'll show you what it looks like using the MER, market exchange rate basis. It would be nice in the paper to have some attribution analysis, because you've made reference to this of how GDP and consumption are changing, but taking that apart, because the numerator is the numerator, the consumption is the consumption, but the GDP, taking the basis aside, if you're decomposing, like, what's the longer term concern for GDP growth, people talk about changes in graying populations, demographic trends, slowing demographics, and how that is, that the past isn't necessarily predictive of the future. Christoph, you made reference to getting services out of oil. The fastest growing part, and for most petrochemicals that grow at a multiplier over 1 of GDP, is the 30 to 40% of global oil that goes into materials or into industry. So the non-energy use is it's not an emissions concern, and it's certainly a fast-growing source. And you could argue with graphene and things like that that could be sourced from oil and natural gas in the future, that it's both it complements to be able to continue to grow oil and gas for those applications that then lead to developments in lighter materials, better energy density in batteries, things like that. And then lastly, coming back to, is this a forecast or a rule of thumb? I think it's a rule of thumb and not a forecasting tool, but let's take that. So the trend over time, this is a plot I often use, and I've overlaid a regression analysis with it, but the horizontal axis is the size of the economy and the vertical is global oil demand in million barrels per day. And you see the trend, and this is consistent with what you're describing. The economy was much more oil intensive in the 1970s, with a little bit of variance with the Arab oil embargo in 1974, up to 1979 with the Iranian crisis. You get really high oil prices that are a tipping point for the global economy into a double dip recession in the early 80s. You get the corporate average fuel economy standards in the US and the European equivalents coming into play, diffusing globally. In response to that, lighter weight vehicles, front wheel drive, and for a period until about 1986, it changed the way the world used oil temporarily. After that, and I think from that period to 2019, it is largely linear, and I think you're right. But if you take the whole of the period, including both the outlook period from EIA and the history here, it really is, it's close to linear, but it's really a 3-parameter logistic curve. So it rises, but it rises at a diminishing rate. And when you fit this regression, it's so strong that it's basically collinear at that point. So there is some diminishing returns to it, and which period you focus on really does shape how you'll look at that. When we decompose the same basis by region now, a couple of important points. Let's look at OECD, the developed economies versus the emerging markets. If you look at OECD, wow, the trend between GDP and oil demand really has responded over time. It's not so smooth, it's not so linear. But look at the non-OECD or emerging market trends. This is a function of the IEA's data methodology, because they're using some of these very inputs on the economy side and trade data to smooth out and forecast and fill in the gaps for all these emerging markets where you don't have actual consumption data. So point one is to just take the data apart and really realize that some of this is estimated from the pieces. Then on a market exchange rate basis, if you look at the energy intensity or the oil intensity over time, the oil to GDP ratio, you see the same kind of trend where it goes up in the early 1970s for the emerging markets. It's pretty much consistently gone down, with the exception of the very early 70s for the developed markets. Notice that these trends basically parallel over the last decade or so. They're not showing the regional convergence on a market exchange rate basis. And in fact, if you take the EIA estimates for this year and next, they actually go the wrong direction. They're not continuing to improve there. So this basis on how we look at the global economy also matters. And you see the difference in terms of the market exchange rate basis versus GDP. Let me pull it up a second here. So, if we're just looking at how that ratio improves over time, for the developed economies, the adjustment for purchasing power doesn't make much difference, but it really does for the emerging markets. And anytime you use this adjustment for purchasing power parity or purchasing power in the emerging markets, effectively you're putting about 2 to 3 times more weight on China and the other emerging markets. If you especially model this at a regional aggregate or global level, you get more dollars of GDP measuring the world in terms of purchasing power parity terms, and you get a higher growth rate. So when that's what's sitting in your denominator, effectively, it gives the appearance that efficiency, to the extent you interpret this ratio as a measure not of technical efficiency, but as systemic overall efficiency or progress, it tends to overestimate the extent to which that is improving. And then the detail in the energy modeling, having done this at multiple stops, including ExxonMobil, is that the World Bank, ExxonMobil, they tend to model everything on a market exchange rate basis. And there are good reasons, especially for affordability of certain appliances for vehicles, to adjust for purchasing power. But the stability of those things and the economic assumptions that go into it, there's a philosophical debate that goes into this. It doesn't really matter unless you fail to, and I've been at least one place where I've worked where they'll go to the economic literature, take an elasticity and say, this is the relationship. You can't do that in this context. You really have to calibrate and estimate econometrically what those elasticities are between the GDP series and the consumption series that you're specifically using. So devil on the details. Shifting off of the paper, I just want to highlight quickly the things that I think that matter most, because the long term is made up of many short terms. How we get from here to there really matters in bridging into an energy transition longer term. The first thing, and we've been saying this since really the third quarter last year, is that the US and global economies really are on track. In fact, on a market exchange rate basis, the only 2-year period that looked stronger was in 1972 to 3. I've already made reference to the IEA's outlook. The US Energy Information Administration has an identical forecast of 5.4 million barrels per day of growth this year. Over 2 years, this year and next, we've never seen world oil demand growth higher. So 9.1 million barrels per day of expansion this year and next. And what makes us believe that is the actual recovery since the 2020 COVID-19 recession, where in the American Petroleum Institute, we are a primary source of data for US petroleum markets, surveying up to 90% of the industry each week. And just yesterday, we issued our latest monthly statistical report. We put these monthly estimates out on supply, demand, trade inventories of crude oil, natural gas, liquids, and every major refined product 2 months ahead of EIA's estimates here. And what it's shown is, from April, US consumption of 19.6 million barrels per day. And that was within 3.5% of where it was in the second quarter of 2019. And that April 2019 point, by the way, was the highest in 11 years. And for gasoline was the highest ever for that month. So this is a really high benchmark and we're close to it. EIA's estimates on a global basis, basically within 4% as of April back to 2019. So for everything through the pandemic, for all the dislocation, we're right there. And the biggest source of growth really has been, in terms of oil, has been oil going into materials. So naphtha, gas oil, propane and propylene, going into packaging and materials, shifts on online retailing. And as we keep seeing more variants of COVID-19, a continued need for medical plastics in particular. So the supply side, just talking about that briefly, the thing that really pops in the data, and I'll highlight this quickly in 2 more slides, is that there's a divergence between this record demand recovery and growth and record low investment. It's highlighted in the lower right here, $38 billion worth of industry-wide investment. So this is global companies, but ones that are publicly listed on US stock exchanges, 200 companies through the value chain. And we look at this as both a flow over time and as a stock. The flow, the company reports to the Securities and Exchange Commission, or what's shown on the left-hand side, rolled up by industry sector. The green shaded regions here, upstream resource development is the largest part of it. And then global integrated companies that have large upstream resource development components, that's your biggest pulse of where investment's going. And you see just how low it is, the $38 billion in the first quarter, and that it's never been lower, even during the lowest quarters of the great financial crisis in 2008 and 9. Now, as a stock, $174 billion worth of downstream and midstream projects in the industry in the United States under construction as of this last month. Now, if you were going back before the shale revolution, this would have been fantastic because the US went a whole generation without having seen multi-billion-dollar projects like this move forward. However, compared to a year ago when this backlog was $344 billion, it's almost been cut in half. And if you think of this as a funnel of new large capital projects, investments going in and others coming out, many have been completed, many have been canceled or delayed. And we do not have new multi-billion-dollar projects at the same healthy rate coming in the front end, because in this price environment, with structural changes to the industry, with an inability to finance things, it's been just very difficult to get these projects off the ground. The last thing I want to highlight is it's not just a US issue. the global energy investment trend shown here from IEA, stacked up with, from Baker Hughes, the international drilling activity. You see, this corroborates the importance of the upstream resource development activity and how much is drilling, but the trends go in lockstep, and you see that globally it's gone down. And outside of the US, the other place you can go for relatively quick and low lifting costs of oil is the Middle East and North Africa. So API Corp, the Arab Petroleum Investments Corporation, which is a Saudi Arabian-based multilateral investment bank, they track the projects over a 4-year outlook that are committed versus planned. And in the committed projects, the punchline is that year on year, you won't be surprised that through the crisis that we've had this last year, that the overall aggregate amount of investment went down. In the committed investments, oil is more than 40% of that. But in the plan period, it's only 20%. So here we have record demand, record low overall investment, and oil in the key regions losing share to power and other sources. So think of the economies in that region, which are on a mission to diversify the economy off of oil and gas, and multilateral banks, IMF, the World Bank, others willing to lend on that basis. So these are the challenges. So how we get to the long-term energy transition when increasingly it looks like we have spare capacity to make ends meet this year. Increasingly, if the economy stays on track for this record amount of growth and oil demand growth into next year, in my view, the numbers just don't quite jibe. So the markets have gotten tighter. We'll see what happens. And I'll stop there. Welcome questions. Thank you.
Great. Thank you, Dean. Appreciate that. Christoph, I just want to give you an opportunity to react. I mean, Sarah focused on the importance of policy as kind of driving that step change that you asserted early on in terms of putting us on that new pathway that you documented since 1984, and the role of price in driving policy to that. Dean talked about the need to really kind of dig into the the detailed data analytics and the need for caveat emptor, as always, when it comes to data sources and a bit of humility around what it is that we're actually trying to measure before we can even try to model it. And so again, just very briefly, would be interested in your reactions to the commentary that we've received so far.
So thank you to both of you, Sarah and Dean, for these extensive comments. I appreciate them. Let me proceed in 2 steps. There's something I need to shut down first, unfortunately, before we come to the constructive part. Dean, you seem to be implying in the number, and I don't want to talk about numbers too much, but I need to at least clarify something. You seem to be implying that our results would have been different had we not used purchasing power parity, but market exchange rates instead, if I understood you right. Now, this is a bit, I hate to do this, but we did use market exchange rates. We didn't use purchasing power parity. I think the saving grace is that the slides you showed with slightly different pictures didn't model what happened from 84 until 2019, like in our case, but you started somewhere in the early 70s. And then, of course, you get a very different picture. Remember, our story was that there's a regime change here. There's a regime where oil grows faster than GDP, which sort of ends with, as you pointed out, the second very dramatic price shock after the Iranian Revolution, 79. And then we have this long age of relative stability not in oil markets, only in the relationship between oil and GDP, with oil growing but slower than GDP. And then we may, once peak oil is there and peak oil demand, and if it's here to stay, not just a one-off, we may enter a third sort of kind of regime. We make no claim whatsoever to know how that look like. So when we talk about forecasting, I was using words which were too big. I actually agree very much with your statement that this is a rule of thumb. So when we have peak oil demand and when it's here to continue, God knows what happens. I would not claim that there's any kind of stability in that system necessarily. But what we are saying is that until that happens, this seems to be a good rule of thumb. So on the forecasting versus rule of thumb, I'm with you. I'm not in the business of doing monthly, daily, or even yearly forecasts of oil prices. That Mark can testify. Years in the industry have cured us from that, probably. But rules of thumb are important, and sometimes better, and sometimes even more accurate than forecasts. So that one falls in the rule of thumb department. Then I would like to focus on something you both came back to. Sarah, I agree very much. This is an issue sort of public policy which looms at the horizon here. And also Dean, with your second part of the argument, basically saying that if we are not careful in the current environment with the energy transition and all these demands on companies, we are running into an investment gap. These are things I would subscribe to. And let me add, I'm someone who has been laughing at the IEA and OPEC and their sort of perpetual scaremongering about investment gaps, which they always draw up and prices tend to be low. I've been laughing that successfully for years now, because it always was announced, it never happened. But we are probably in a situation where, when we now look at the delay and the response of oil production in the US in particular, and in the shale patch in particular, to these very high prices in this ongoing game of control over the market between OPEC and the rest, when you look at it, where the combined difficulty of securing capital for long-term things which are not liked by the public, with this whole public relations, sort of, should we call it, this whole general attitude towards the energy transition and oil being one of the major culprits, may probably lead us into a position, if not an investment gap, then surely, as even the IEA forecasts, a much, much higher concentration of oil and also of gas production within OPEC. The IEA itself has, in the scenario Mark mentioned, assumes 52% of oil production would go under OPEC control. That's unprecedented. So one more thing to Mark, the petchem story I don't buy. I know that is the last hooray a little bit of the industry. In every forecast before the energy transition became so prevalent, this was the thing people held on to. They said, yeah, but a big share of the demand comes from petchem. True, but that's just because the demand for transport, for power, for everything else was constantly downward adjusted. So that left the petchem demand, which marginally upward adjusted or not at all adjusted, in a much stronger position. But I think if you do the numbers, and we did them also with Teal Erica, the same issue, on plastic consumption and the so-called war against plastic, what it would mean globally if the plastic bag disappears and plastic bottles fall in half and all this kind of thing, then you see that petchem demand is unlikely to save, the oil industry from peak demand if it's come. What is more likely is, of course, that there's a big impact of the energy transition, and that there are all sorts of measures being taken which constrain supplies, as Dean has said, without first having taken care that there is something to use as a substitute for oil. So just, so to speak, you have your hybrid car, battery doesn't work as expected, but still oil production is going to be constrained. That gets us into a very potentially volatile area of high prices and shortages in production, all of that, and how that is managed on the public policy side. In each country is an open question. That was probably what Dean was asking. Sarah, I understood, went a little bit further. She was asking public policies in a global sense. And there, for me, it's not so much of will we get a global carbon price or not. For me, what is happening here is a different threat in the oil markets globally. That's the threat of a quota system. We have seen this in April 2020, sort of looming its head a little bit. Everybody agreed the world was going under and had to be saved. And then we had this meeting, as you know, between OPEC and OPEC Plus, and with the support behind the scenes of the US, and basically a lukewarm but still endorsement of the G20 to say, okay, guys, cut. At the point of that meeting in April 2020, the IEA forecast for the decline in oil demand consumption in April 2020 was 23 million barrels below April 2019. And the forecast for the year was 9 point something, almost 10. And so the OPEC cut, which was agreed, and OPEC Plus cut for the year, so accounted at that point for 1/3 of the global demand at that point in time, and the rest was left to the market. And then as demand recovered in the system, unplugged, and so the OPEC directed cuts in this 2-year plan account for a higher share of the total. And now we get what we deserve, in a sense, because the G20 agreed to use non-market measures to curtail the supply. If you would have left it to the market, maybe it would have been a bit more painful. Certainly the US had their own companies at risk. They would have suffered more from declining prices much sharper. But now we surely would be in a world of 40, maybe 50, maybe 35, who knows, dollar oil, which would be a market price. And that's not what you can claim now with a system with 5 million of spare capacity, and the oil price at 75 and shale being reluctant coming back. So short answer to what Sarah thinks, yes, it's a big matter for public policy. I'm a little worried that under the guise of if it's just a carbon price, I'm fine as an economist, but that under the guise of the energy transition, we will see Saudi Arabia, Russia, and the US and their respective entourage agreeing on saying sort of a managed system, because we can't allow, we now all understand we still need oil. I can just see the logic of the argument. We will scale it down as fast as possible, but we will not, leave Joe Blow without his pickup for the time being. And so let's agree on a productions, on a way to do this smoothly under the guise of avoiding volatility. That would give Saudi Arabia and Russia monopoly profit still, which they otherwise would, a price war would put into danger. And that would give the US probably that would be their motive, a continued place in the sun of being not becoming a net importer anymore. Being this net exporter of oil, gas, and coal is a brilliant position to slap sanctions on other countries. And I'm sure the strategic value of that is recognized. So that is a minuscule chance, I would hasten to add from today's perspective, but that's a perspective which may happen. That would not be good news for all of us. Different from a carbon price, which I think we can live with, or the market can live with.
Scary to think that for many of our listeners here in the United States who lived through the experience of negative oil prices, scary to think that it could have been even worse. Let me back up. There've been kind of a couple of threads here, and some questions have been coming in from the audience as well, along the lines of, how do we weight these different factors? I mean, we've talked about structural change. We've talked about sectoral shifts from, industry to, more of a consumer demand. We've talked about globalization. We've talked about policy and price and kind of innate technological change and innovation. I'd be interested in each of the panelists' thoughts about how do you weigh these? I mean, when you're thinking about oil demand over the next, 20 or 30 years, which of those are, the one or two that you say, yeah, that is the one to really keep the eye on? Sarah, Dean, do you want to lead with that? Sarah's got her hand up. Huh? You don't need to raise your hand. We're all friends here.
I want to make one little quick comment though about the petchem, because this is an important one. And I did a little back of the envelope just before we started, just to double check this. But we haven't really talked about what is oil, because it looks as if you're using in your oil demand, your oil consumption numbers are sort of total oil demand as defined by the EIA or the IEA.
Total liquids as in the statistical report.
Exactly. So the question is, total liquids includes natural gas liquids and alternative fuels. And if you look at the period from 2000,
no biofuels. Sorry. Just to clarify, derivatives from oil and gas, no biofuels.
You did not include any biofuels in your demand.
No.
Okay, but you included derivatives from natural gas. So if you look at because the biofuel numbers are still quite small. But if you look at NGLs between 2005 and 2019, that number went up about NGLs as a portion or grew by about 4 million barrels a day globally. Whereas crude and condensate production grew by about 6 million barrels a day globally. So, that's almost comparable. And so when you're thinking about oil demand and even oil intensity, it would be interesting to look at this analysis by looking just at demand for products derived from crude oil, which have been going down probably a little bit faster than perhaps the trend you've described. So that's just something to think about on petchem, because petchem's interesting, but the feedstocks are increasingly ethane and LPG. In terms of priorities, so we do. My firm does demand a little differently. We are actually tasked with getting all that non-OECD data. So obviously IEA and all of the IEA countries provide great data. But we actually try to get data for everybody else as well. And where we can't get data, we use trade data and facility data in order to estimate that consumption number. And we look at every product by every country and build it all up from the bottom. And that's why I find these rules of thumb from the top down kind of fun, because you can sort of do a nice little check. Does it make any sense? But as you build things up, and when we look at that, I have to say the number one variable that knocks a country's demand for one particular product on or off a path is some form of regulation. It's usually a tax, a subsidy, an environmental regulation. It's not these big grand carbon taxes, it's other things. And countries change these all the time. We'll go through a period of low oil prices and they'll add subsidies. You go through a period of high oil prices, they'll remove, well, I'm talking about the producers, but for consumers, you do the opposite. If high oil prices, you would add the subsidies, low oil prices, you would remove them. And you see this happening all the time. So it is a variable that we're constantly seeing changing. I'd say every 2 to 3 years, you see some countries made a change in how it treats an individual product in their country, especially some of the critical products like diesel and LPG. So for me, it's that sort of fine-tuning regulatory fiscal measures piece that seems to move the needle the most.
How about you, Dean? What are your top 2 candidates?
Okay, so top 2 things. I mean, clearly for oil demand in the future, it's the transportation sector and it's the industrial sector. In the transportation sector, we really are looking at how far policy changes can promote and push electrification in transportation and shifts to alternative fuels and maybe eventually hydrogen. So we'll see how those systems and the technology and consumer preferences interact to change that long term. On the industry side, I take Christoph's point, and I actually agree that it can't save oil demand, certainly not from the peak demand notion as you go through an energy transition. But it is material. And for the US, our data that came out yesterday for May would say that the other oils, the naphtha, the gas oil, the propane, and the propylene together in the way we measure them, as of May, were up 13.5% over what they were in May 2019. Forget the year-on-year comparison because the base year is so low now. So this is just a phenomenal and structural change, and it's going together with the investments in the expansion of petrochemical facilities in the US. To the extent that everybody in emerging markets continues to go up the income chain and want the same consumer goods that the rest of the world has, a lot of those are plastics. And I agree with Sarah that a lot of those are LPG and NGL based. On the GDP side, which would be the last thing to comment on, taking the basis out of it, just decomposing it into labor and labor productivity. The question that I think is longstanding and hasn't really been answered well in the literature is, how does labor productivity continue to almost defy gravity? So if you look, and I think, Christoph, you do this for some of this, where you decompose and say, what are the greatest changes historically? But if you take GDP apart and say, how is it that I can continue to grow the world at 2.5% per year indefinitely with dropping demographics? I have to have productivity that picks up the slack. And it's not clear exactly where that comes from. That would be the other element I think that's important to these long-run models, is really understanding, again, the basis on which it's built and whether it's credible. But again, good paper.
Christoph, Sarah, go ahead. Go ahead, Sarah.
I had a question based on the conversation before, but I don't want to disrupt you here, Mark. But and it was a question about the underinvestment. And this is a common theme. It's almost a meme in our industry right now, that this underinvestment. And I don't really want to get into that argument, although I don't fully agree with it on the non-OPEC side. But if there is underinvestment in non-OPEC, and we still have, let's say, 5 million barrels a day of spare OPEC capacity, Christoph, why do you feel this is going to be a bad situation for OPEC?
I'm not saying that. I wouldn't call it underinvestment if there's still 5 million capacity. I was talking about a situation when the capacity has been exhausted and there is underinvestment.
Further down the road.
And then you have price volatility, and you have a much faster return of shale and of other private producers. And that in the short term would be bad news for OPEC, because they would have to crash prices to deal with that. On the 2 questions from Mark, I look at this from a global level, and there really doesn't matter whether it's liquid hydrocarbons or crude oil. I mean, when I said we did the numbers, it doesn't make a difference. What I would say is, number one,
sorry,
the most important driver is, like Dean probably said, is the economy, and is not just in a simple notion of economic growth. Somewhere I read, I may be wrong now, but somebody saying that for the last X years, 30, 40 years, every human being consumed 4 liters oil per day or something like that, per head, in a certain time frame. Hasn't changed. So I don't know the numbers on that, but it's not just the big GDP growth, it's also the composition of GDP. It's very interesting. We know two things. We know that every single economy in this world goes from agriculture to industry to services, number one. So far, exceptions in the Middle East, perhaps, but otherwise, yes. And then we know that in terms of primary energy consumption, it goes up from agriculture, it peaks during the industry and goes down again in the services, but oil is lagging. And that has, of course, to do with all the different ways in which industrialization can be done. And that has to do with the importance not of the composition, but of income levels for the amount of people driving and for the private final consumption in oil. Mm-hmm. And that, I think Sarah is right, whether it's regulation or not, but has to be undone country by country to say anything meaningful. Mm-hmm. And the other aspect is a completely hypothetical one, but important one. I wonder a lot, and I have no answer, how the actual energy transition, as opposed to all this hot talk which we have now, will affect oil demand. Where first, which consequences for producers, which sectors will be squeezed, will it really tackle where most of the oil is consumed? So these kind of questions, so I'll leave it there.
Yep, that sounds like a great topic for a subsequent paper, Christoph. I said, knowing that Christoph has a paper on that in the works as well. We've really focused, given the context of this conversation, on what kind of factors could push oil demand lower and cause people to keep cutting their forecasts. In the interest of time, I want to keep this very short, but for balance, are there upside risks around this outlook and this conversation? If so, what would be the sources of the upside risk? And let me ask you each to just kind of keep that to just a minute, please, if you don't mind. Upside for oil demand, that is.
Just clarify, what is upside risk? More oil demand or?
More oil demand, yes.
Okay. Sudden rule of markets. If you take out OPEC, you leave in shale, and you explore it worldwide, you have a period of, we have resource abundance, we have oil resource abundance. And without politics, you would probably see a boost in demand like you did in the US.
Okay. Dean?
So this rule of thumb, this is the upside risk, because almost every energy model out there and official estimates assumes historic levels of technical efficiency, economic productivity, things that continue to bend this curve over time. So if this rule of thumb remains sticky, and where I at the very core agree is that oil demand is super sticky with the economy here, then that presents something that exceeds the conventional wisdom of where the energy transition and policy are likely to be headed.
Sarah, how about you?
Yeah, I mean, to me, again, it comes back to politics. I mean, I think you could argue the Trump administration was a hiatus in the decarbonization path. And you could have that again in other countries, and you just following China and some of the areas where China has backtracked. So I think those are the kinds of things that can have an impact that would slow decarbonization policy and lift oil demand.
Right. And we saw just this week in the G7 meeting that apparently there were conversations about taking more aggressive stances that were watered down in the final communique. Yeah. Some of these are hard choices. All right, one final question for each of you. And let me just preface this by saying, give me a single number and that's it. In what year does oil demand peak?
Who is first? Me?
If that's what makes you happy.
Totally drawn out of hot air, I would say 2029 and a half. Don't ask me for the level in the
Here we are, June. Okay, got it. Perfect. All right. Thank you. Dean, how about you?
In more than one word, affordability, household affordability really matters, but I would guess 2033.
And Sarah, you get literally the last word from the panelists.
Just above or just below them, right? So in March, we published 2029. I could see it being 2030.
All right. So let me just wrap up with a few very brief introductory or concluding remarks. Gosh, where to start with this? I mean, first of all, I think it's always worth remembering when we're having these conversations. We talked about models, we talked about rules of thumb. These are tools. There is no accurate description of the future. There is no forecast, there is no scenario, there is no model that will be right. The whole point is to add insight, through the analysis. And so hopefully that's what we've accomplished here. I'm not sure that we've come away from this conversation with a precise timing of peak demand, our expert opinions notwithstanding, but I do think we came away with a better understanding of the forces that will impact future trends. One brief programming note, next Tuesday, the 22nd of June, my colleague, Ken Medlock, will host Eirik Vernes, Equinor's Senior Vice President and Chief Economist, for a virtual discussion of his company's new energy perspectives, which should be an interesting talk. Those of us here on the US East Coast and in the Midwest have just been living through one of the world's great natural wonders, the 17-year cicadas. Dean and Sarah may not agree with me in my characterization of that as a great natural wonder. Billions of these little red-eyed alien clones, from the so-called Brood X, have been swarming our neighborhoods, keeping us indoors with their deafening calls of mating, grossing out our kids, and allowing our pets to just gorge themselves silly. We won't see them again until 2038. Hopefully, we won't have to wait that long for clarity on global oil demand. Christoph, Sarah, and Dean, thank you for sharing your expertise with us today. Thanks as well to the team here at the Baker Institute for their support in putting this webinar together. And most importantly, thanks to all of you for sharing part of your Friday with us. Enjoy your weekend, and please join us again soon.
Thank you.
Thank you. Thank you.
Thank you, Mark. Great. That was a great analogy.
Great ending.
Yeah.